If you're dividend investing, do not make this mistake. Now, there's really only one question that you ought to be asking yourself in order to avoid that mistake just before you actually commit to dividend investing and choosing a dividend investing strategy. And that question solely comes down to what the heck are you investing for? Now, believe it or not, there really aren't any right answers to this question, but we do have to be honest with ourselves as investors about this particular question if we really want to level up as dividend investors. And now, just drawing on a personal mistake, or rather several personal dividend investing mistakes that I made, I'm just here now to set the record straight for myself. I'm also here to commit to course correcting, and then most importantly, I'm really here for all of you to transparently share everything I can so you can just totally avoid all of the mistakes that I made, and then hopefully you're going to reap the rewards of dividend investing much earlier than I did. Moreover, I can honestly share with all of you that getting real with yourself about why you're dividend investing, well, that didn't only make me change my entire outlook on dividends, but led me down an entirely different path and made me rethink my dividend investing strategy. And now today, because of all the hard questioning and decisive actions that I took that came thereafter, I'm sitting on north of $250,000 just in my brokerage account alone, all because I dared to actually get real with myself as an investor. So again, I'm going to ask you, what on earth are you actually dividend investing for? Perhaps it's because you are gunning for financial freedom. It's likely the case for many of you. Maybe it's because you actually want to retire a little bit earlier, or maybe you just want some extra income to help with, say, groceries or gas, or really just have extra pocket money to enjoy. Or maybe for some of you, if you're really honest with yourself, it all comes down to you just wanting to self-promote as someone who's basking in the passive income river streams. Perhaps this is like an addiction, or maybe you're receiving dividends, that's what's keeping you motivated. And that's all fine by me, whatever your reason is. But now I just want you to be clear on it, because if you're anything like me, someone who really is hungry for financial freedom, someone who really does want to retire a little bit earlier rather than later, and then most importantly, someone who's already making just about all of the necessary sacrifices in the world to make this whole dream come true, then you shouldn't be here playing games and investing in high dividend stocks when you should be in fact oriented more towards growth, or vice versa. You might be ramping up on dividend growth stocks when you really ought to be playing it much safer with some higher yielding dividend stocks. Now, this all really comes down to your investor profile, something I often talk about here on the channel. That's first and foremost your age, but it also comes down to your investment timeline. So how long you're actually going to be able to allow your capital to remain invested, and then your risk tolerance. With that said, I now just want to go ahead and look at a few examples with you so we can really all be on the same page here in terms of setting ourselves up for massive success. Let's start with avatar number one, the early 20s wannabe passive income or dividend income millionaire by like age 22, 30 tops. This investor is typically inexperienced. However, to their benefit, they're usually insanely excited and incredibly hungry for dividends, and therefore they really seek out the highest of paying dividend yielding stocks. But to this investor's detriment, their fate is usually sealed as a rags to TJ Maxx success story versus the rags to riches. Now, I'm not here to say that all higher yielding dividend stocks don't deliver through on growth, which is necessary and important for younger classes of investors, but I am throwing this generalized objective statement out there for all of you to chew on. They are just not the right fit for this type of avatar in their 20s or even in their 30s and sometimes 40s. Now, a perfect stock example here would be Verizon, whereas it will likely remain an outstanding company, especially for its reliability and deliverability to shareholders. But clicking into the stock chart, I want you to see it for yourself, that its impressive performance as the S&P itself sank over the last few days from the market jitters ultimately leads to a lackluster performance over the course of the year, with the S&P up by almost 20% to Verizon's measly 1% rise in terms of appreciation. Now, on the 5-year chart, don't even get me started here, Verizon just gets smoked. Now, this is exactly what I want to have your attention on if you are that young, early 20s or 30 something investor. Because while Verizon was trading for about $60 a pop back in the 90s or early 2000s, it has never really seen the light of day or those higher highs come today. I mean, you could just see it for yourself. So sure, that almost 7% dividend yield may seem exciting and incredibly attractive, but regardless, to total return, which is what we really all should be after, Verizon is just a no-go for me at this point in time. But if you're busy avoiding all the higher higher paying dividend stocks at this stage, then where exactly should you be looking? Well, as of this video, according to my investor profile, I'm a 30-year-old investor with decades worth of time to go before I even think about retiring. And then a decent risk tolerance level. I'm not crazy, but decent risk tolerance. I'm personally looking into the Visas and the United Healths of the world. Now, before 2024 ended, I loaded up on quite a bit of United Health and only plan to really grow this position to over 100 shares within my portfolio as a stock in focus for 2025. Now, likewise with Visa, as it's also another stock in focus for me. But keeping to United Health right now, we can go ahead and click into their stock chart to discover it's only up right now by about 5% year to date here in 2025, and even less than that on the year chart, as we could see right after their CEO Brian Thompson was murdered. Well, it faltered. But here we are in the 5-year chart. This is what matters, the long term. We're up almost 80% worth of appreciation. Now, comparing that to our pick with Verizon, we can see that while United Health delivered through on plenty of growth for their shareholders, Verizon actually depreciated over that same period of time and would have actually lost you money depending on your entry point or your buy-in. And as for Visa, well, we see very similar results, with Visa kicking back 11% to shareholders versus Verizon's 1% on the year. And over the 5-year period, now we get over 66 or about 66% to Verizon's negative 30. So in both cases, while Verizon wins the battle in terms of the dividend yield, it ultimately loses the war in terms of total return. Not to mention, having your dollar just compound with a dividend growth stock will certainly reward you much more than a higher paying dividend yielding stock that pays you more in dividends right now. It really then all comes down to this thing of delaying that instant gratification, holding out for a moment, a second, days, weeks, or months, and even years longer to actually achieve more. Now, if you are in your 30s or in your 40s, you're really in a position to then focus on growth, but you can also be my guest to put a little more emphasis on dividends if you feel that's what you must do. Now, you should take your Procters & Gambles, maybe Home Depots of the world that yield 2+% in terms of dividend yields, which we can see here on the screen, that then proceed to dominate over the Verizons of the world and reward you more in terms of, again, total return at the end of the day. But hear me now. If you are nearing retirement or already in retirement in that pasture, you have my full support and even encouragement to invest into those higher yielding dividend stocks because you lack the time in the market. Or on the other end, you really do need to play it safer. Now, even more importantly, you just may be in the position where you need that income, and that's where these higher paying dividend income stocks are going to help you the most, not necessarily those dividend growth stocks. So this leads us to, the Verizons, Philip Morris's, Realty Incomes, and Dow Chemicals of the world delivering through on the yields of, say, 6.16%, 4.49%, 4.89%, and 5.27% respectively. But investors, I'm going to leave you with just one last question now for you to really think about, mull it over, and then answer for yourself. What the heck are you actually dividend investing for? Because if it is in fact to get the job done, to get financial freedom and get this job done right, then I implore you to check out your strategy if it's actually going to get you to where you want to go. Now, if you're brave enough to really drop your answer, truthful answer to that question in the comments below, go ahead and do so now. But definitely be sure to check out this video right now if you haven't already hit $100,000 in your brokerage account, as it's meant to help you achieve that milestone much faster. Of course, subscribe if you're not already a part of the community. You really ought to do that. But until the next video, I will see you all there.